Foreign Currency Translations Reserves, FCTR. What on earth is it? I can tell you there are millions of accountants on this planet, most of whom have got no clue. And it's one of those numbers at the bottom of the balance sheet that appears once or twice a year as a company do financial reporting, that most people actually have no idea how it is, what it is, how it comes about. Okay, so in this video, we're going to walk through what is the FCTR and basically how it's calculated. Okay, so let's start. Presume we've got parent company, Aussie dollar parent, and a subsidiary, US dollars, American subsidiary based in Delaware, selling to the US market. Okay, now we're an Australian company and we 100% own our subsidiary. How do we consolidate these two entities together from an accounting perspective? First thing to know is what's the functional currency of each entity. So the functional currency is the currency of the balance sheet, a currency that the entity operates in. Okay, and so in this case, our parent entity is Australian dollars because its share capital is in Australian dollars, its bank accounts Australian dollars, and it operates in an Australian environment. So that's pretty simple. We've also got a US dollar subsidiary. It's an American company based in, I said, Delaware or somewhere in the US. It's got a US dollar bank account. It's got US dollar share capital, has income in US dollars, pays expenses in US dollars, and for all intents and purposes is an American company. It just happens to be owned by an Australian parent. So how do we bring these two things together? Well, the second part about this, to bring this together, is what's our reporting currency or presentation currency, as the accounting standards talk about. Okay, and so we can present our accounts in any currency we like. We could present them in euros, in yen, in Brazilian reals. You can present your accounts in any currency you like. But we'll keep this one simple. We'll present our accounts in Australian dollars because our parent's Australian dollars and our shareholders want to understand our results in Aussie. So how do we go about that? So knowing these basic facts, the first thing to do, obviously our parent entity is in Aussie dollars already, so there's no translation needed, but our subsidiary is in US dollars. So we have to get our US dollar entity from US dollars to Aussie dollars. And we've got two parts to this. We've got a balance sheet and a profit and loss. So how do we do this? Well, the balance sheet is quite simple. We take the spot rate. The spot rate is the FX rate on the last day of the financial year. So if you've got a 30 June year end, it's the rate at 30 June. If you've got a December year end, it's the rate at 31st of December. That's simple. And you simply take your US dollar assets and liabilities and you translate them into Aussie dollars at that rate. Then you've got a profit and loss. Now, if you think about it, the balance sheet kind of makes sense because balance sheet's as a point in time. Okay, and we've got an opening balance sheet in Aussie dollar and US dollars, and we've got a closing balance sheet in US dollars. And so we translate the opening at the opening rate and the closing at the closing rate. That will give you an Aussie dollar closing rate number. However, the P&L is a little bit trickier because the profit and loss is over time. It's from the first day of the year to the last day of the year. How much profit did we make over that period of time? Well, hopefully we made a profit. And so how do we translate that? Well, accounting standards and accounting convention tell us there's a couple of ways of doing it. You could either translate it every day at the spot rate every single day, or you can use an average rate. And most companies, for ease of accounting, would simply use an average rate. Now, if you're using a big ERP system, an Oracle or an SAP, it can do this every day, it can do this every month. Or you could do an average annual rate for the year. Whatever's easier. This doesn't actually matter, as long as it represents what the P&L should look like over time. And so you've now got assets at spot rate, you've got liabilities at spot rate, and the equity section, you've got profit and loss, because that's retained earnings, at an average rate. And we're missing actually two more components. First component is our share capital. And so what number do we translate the share capital at? Because share capital isn't an asset or liability, no, spot rate, and it's certainly not profit and loss. And so I want you to imagine for a second, decades ago, we made an investment into the US. We've got $1 million Aussie dollars. Now we sent those $1 million Aussie dollars off to our subsidiary in the US, our new subsidiary, as its share capital. And it has, say, 500,000 US dollars share capital. Here we are, many, many years later. The question is, what rate do we translate that at? From the parent entity's perspective, it's still got an investment in a subsidiary at $1 million, Aussie dollars that is. But the subsidiary itself, it's got 500,000 US dollars in its balance sheet as its share capital. But we've got a different FX rate today. So we can't use a spot rate, because if we use a spot rate, we'll get a translation difference. And for equity, that shouldn't occur. So what you do is you translate the equity at the historic rate. All right. So you go back in time, and this is why it's important to keep good records. You go back, to 10, 20, 30 years, whenever you made the investment, and translate it at the rate on that day. Okay. So in our case, we will always translate our 500,000 US dollars to $1 million Aussie dollars. And then when we do our consolidation, we bring our investment in the subsidiary and you offset that against the share capital of the subsidiary and net those two out, they will always equal. Now, the last part about this is retained earnings and dividends. And again, historic retained earnings are similar to in some way similar to share capital, because we're taking historic rates. Every year there's been a build-up of retained earnings in the business, and we translated that at the average rate. If you recall a minute ago, we said the P&L is translated at average rate. So what happens now is that we will keep a record of those translations every month, every year, every day. Okay, and we'll translate at a historical rate. Okay, and that's what makes the FCTR calculations a little bit difficult, because you're using all these historic rates. And so you need to keep good records. If you've got a good ERP system, it will do it for you. Or if you don't, it's a giant spreadsheet exercise. What have we got now? Assets, spot. Liabilities, spot rate. Equity, historic rate. Retained earnings, historic rate. P&L, average rate. If you add that lot down, you're going to end up with a difference. And that, my friends, is foreign currency translation reserve. Dare I say, it's a balancing item. Not that accountants like to put balancing items in, but that's what it is. It's the balancing item between those various entities. Okay? And so every year, you'll have a movement in your FCTR as FX rates move. And it can be proved. If we take, for example, translate a US dollar balance sheet with $100 of assets, $50 liability, and $50 retained earnings. Let's just ignore share capital for a second. Okay. If we translate that at a 75-cent rate, you'll get this answer. If you come along a year later and nothing else has changed and translate it at an 80-cent rate, you'll see there's a difference. And that difference is the FCTR movement. And so that's what foreign currency translation reserve is. Now, I'm going to be honest here with you. It's actually used as a dumping ground for a lot of the time. And a lot of accountants don't understand what it is, and most auditors, or a lot of auditors, also don't understand what it is. And so it's one of those areas where a lot of muck over the years can be accumulated into, because if people can't quite get things to work, they shove it in FCTR and no one's going to notice, right? So, unfortunately, though, it's also one of those things that when you have a major transaction, it needs to be recycled. We'll come back to that in a second. Okay, so what happens now when I sell my subsidiary? If you remember a few minutes ago, I spoke about recycling. So my US business has gone along okay, but you know what? I've had a fantastic offer. Someone's coming there and they want to buy me out for 20 million US dollars. This is fantastic. We built this business up and now we're going to sell it. Well, what happens is, from a consolidated Aussie perspective, is that I take my US business out of my balance sheet and out of my P&L. Okay, and I wash that through the P&L as a gain loss on sale. But I've got this little bit at the bottom of my balance sheet called the foreign currency translation reserve. And what happens to that bit is it goes up into my P&L as part of my gain loss on sale, and then back into my retained earnings. All right. And so that's kind of why it's important to track this accurately over time, because without that, you'll get the wrong gain loss on sale. The other thing to remember, and again, just conceptually about FCTR, is that the FCTR, if you get into trouble with it in terms of working out what the number is, it is just a slide between retained earnings and FCTR. If one goes up, the other one goes down. Because if you think about it logically, at the end of the day, your balance sheet's got assets at one rate, liabilities at the same rate, it's got a historical equity number. Okay, the only two numbers that can move if your things aren't balancing properly is between FCTR and retained earnings. And that number can go up and down. So if you do get into trouble, at worst, it's the other side of the entry is going to be retained earnings. Okay, that's a short intro to foreign currency translation reserves. If you've got any questions, get in contact. We'd love to hear from you. Until next time, cheers.